Hey everyone, welcome back. Before we get started, please like and subscribe so that you can see new content that I post when I post it. And today I'd like to talk about all things real estate and whether it's a good deal to invest in real estate versus investing in the stock market. So the typical disclaimers, these are just my opinions. This isn't investment advice. You make your own decision based on your own circumstances and your own situation and your own level of risk tolerance. But I'd like to talk a little bit about real estate investing versus investing in the stock market. And whenever we talk about the stock market, everyone loves to bring up Warren Buffett and talk about some of his greatest investments like Coca-Cola and Apple and the Washington Post. And how much you would make if you had invested in Berkshire Hathaway, which is significantly outperformed the S&P 500. But what I'd like to do is talk about a couple of his real estate investments. And rather than comparing it to his performance in the stock market, or if you had invested in Berkshire Hathaway versus real estate, we're going to just do the bare minimum and say, well, the two pieces of real estate that he has owned for a long time, his house in Omaha that's famous, and this beach house in Laguna Beach that a lot of people talked about. We're going to compare that to how he would have done if he had just taken that money and invested it in the S&P 500 instead. Now, real estate returns are different than investing in the market because you get things out of real estate that you wouldn't get from the market. You get a roof over your head. You get peace of mind, you get a place to raise your kids, you get memories, things like that. So it's not exactly relevant to the stock market where it's just a set it and forget it thing and you never have to think about it. But the returns are not as good as people think. Everyone knows somebody who made a lot of money investing in real estate. And the reason for that is very simple. It's leverage. So if I put 10% down on a house, and it's a $100,000 house. If it goes up $10,000, 10%, the house went up 10%, but I only put $10,000 down and it's leveraged. So I doubled my money. And doubling your money, 100% return sounds really great. But, as I said, it's leveraged return. So the stock market, which averages about 10% nominal return year over year, if you had gotten not a mortgage, but a loan where they lend you 10 times your money, and then you had put that in the stock market. On average, you would double your money every year. The problem is that no one is crazy enough to lend you that kind of money to invest in the stock market. And if you are using a margin account when you buy or sell, the broker will only lend you half. So if you have $100,000, they'll lend you $100,000. That's 50%. And then if the market, which is very volatile, goes down, they're going to make a margin call, and then you have to come up with more money. And the reason that real estate is so attractive to people is because if you buy a property and then the price goes down, there's no margin call. You've got time for it to work out, and the longer you stay in it, it'll smooth upward trend. And all the little ups and downs sort of get weeded out over time. And that's not the case with the stock market. So the stock market on borrowed money, if the stock market takes a dip, you'd have to make a margin call, which you may not have, and you may be forced to sell at the worst possible time. And that's not going to happen normally with real estate, because with real estate, you have a 30-year mortgage, and you don't have to sell if the price goes down. And the mortgage also gives you some optionality, because if you borrow at 8% and then the mortgage rates drop down to 5%, you can refinance, and there's no penalty for that. And if you borrow at 8% and the mortgage goes up to 12%, you can stay locked in at 8% for the next 30 years. And that's a great advantage, because it gives you some optionality, and that also contributes to return. So let's get to the actual real estate, and then we'll go from there. Well, before we do that, I should also say that one of the things that works in your favor with real estate is inflation. So because inflation over time tends to work in your favor, you're borrowing in today's dollars and you're paying back the money in future dollars, and that tends to work out in your favor over time. So for instance, my parents bought a house when I was born in the 70s, and it was $22,000, I believe. And I looked it up recently, and I wouldn't tell my dad what it's worth because he would have a heart attack, but it was like 1.2 or 1.3 million. And that sounds like a lot, but we'll go over why the reasons, it's the return isn't as good as you think. So I'm going to do a screen share, and then we'll take a look at Buffett's house in Omaha, which is famous for buying in 1958 for $31,000, I believe. And then we'll talk about what it's worth now and how much better he could have done in the stock market. So this is Buffett's Omaha house. He bought it in 1958 for $31,500. And depending on who you ask, it's worth about 877,000. Some people say 900,000. Some people say 950, but somewhere between 800,000 and a million. So 31,500 in 1958 to 877,000, which is the most popular guess on what it's worth. That's a 57x over 64 years. So that sounds great. 57x, 64 years, 31,500 to $877. That sounds wonderful. Now, how would he have done if he had just invested in the S&P 500 instead? Let's take a look. So here we go, comparison to the S&P 500 index. If you had put 31,500 in the S&P 500, you'd have 18,223,110.75. So quite a bit more if you had just done nothing and invested in the S&P 500 index. So in today's dollars, that 31,500 would be about $323,498. So that's what a house in Omaha in a middle-class neighborhood, maybe Tulsa, normally would go for. 31,500, and it would be, as I said, $323,000 in today's money. So the fact that his is worth about twice that, that sounds like a pretty good deal. Pretty savvy, but as if you look at what you would have gotten if you had just invested in the S&P 500 index, you could see that you would have gotten quite a bit more. So 31,500 in the S&P 500 index over that amount of time would give you $19,722,167.85. So you have quite a bit more just by investing in the S&P 500 and doing nothing about it. And also that $31,500 price, if he had a mortgage on it, probably he would have paid about double that. So let's call it 63,000. So 63,000 versus 19 million. And when people think about what their house is worth now, they think, oh, I bought it at 31 and now it's worth 700,000. That's a great return, but they don't think about the money they put in. So from 1958 to 2023, he's probably had the roof changed at least twice, maybe 3 times. And I don't know what that was in 1958 or 1960, but nowadays that might cost you on a house that size at least $20,000. Over that amount of time, you probably new boiler, hot water heater, several of them. Change the siding, paint the inside, remodel the kitchen. And those are all costs that take away from your profit. Whereas if you just had bought the index fund and forgotten you had it, it would just keep compounding over time. It wouldn't cost you anything, and just keep growing and growing, and wouldn't require any outlay of additional money for repairs and upgrades and CapEx and things like that. But as I said, a house gives you things that a stock doesn't. It's a place to raise your family. There's an emotional connection to it. It gives you shelter. So it's not a one-to-one investment. It's not comparing apples to orange. It's comparing apples to a hammer. It's completely different. One's hands-on, one is hands-off. But we're just comparing the money, and with the money, even Warren Buffett, who is famous for being shrewd and bought this house for $31,500, which is worth $700,000-800,000 now. That seems really shrewd, but as I said, if you just put it in the S&P 500 index, he'd have almost $20 million more to his name. Not that he needs the money, but it's just the way the math works. So we're gonna look at a couple more things, and hold on one second here. The next thing we'll look at is Warren Buffett's beach house. And this was in all the papers when he tried to sell it a couple of years ago. And he had bought it. It's in Laguna Beach, which is a very nice area of California, right on the beach. So this main picture is on the street. And from this balcony right here, right in front of us, where I have the cursor, or this balcony right here, you have this really nice beach view. I don't want to call it $1 million view. It's a multi-million-dollar view. But this is the outside. You've got this wonderful beach view. As you can see from the inside, you got this nice view of the beach, and there's a cutout of Mrs. C of C's Candies. So it's Buffett's house because he loves her. Very nice house, new kitchen. So as I said, you've probably upgraded a couple of times along the time you've owned it. And who wouldn't want to live here? And he bought this house in 1971. And in 1971, he paid $150,000 for it. And adjusting for inflation, $150,000 in 1971, it's about $1 million. So this house would have been, $1 million house in the 70s. And it made all the papers when after his wife died, his first wife, Susie Buffett, he tried to sell it, and he listed it for $11 million. And people talked about what a great deal this was, because he had bought it for $150,000 and he was selling it for $11 million. Turns out he didn't get the $11 million, and it ended up being sold 2 years later for $7.5 million. So 150,000 to 7.5 million seems like a really good deal anyway, and adds to his aura as a legendary investor. But instead of buying this house, where as I said, you probably had to change the roof a couple of times, he's definitely renovated the kitchen and done other things to it. If he had just taken that $150,000 in 1971 and put it in the S&P 500, he wouldn't have had this wonderful view of the beach, but he would have had 16,542 and $310.92. So that's investing $150,000 in 1971, and then in 2018 he sold the house for $7.5 million, but he would have had $16.5 million if he had just put it in the S&P 500 and forgotten about it. So from 7.5 million to 16, so 2.5 times as well, 2.5 times more money he would have had just from passive investing in the stock market, and not having to buy real estate and pay the property taxes and pay for the upgrade. Yeah, so moving on. Besides the costs of the maintenance and the property taxes and the closing costs when you buy and the closing costs when you sell, a lot of people don't think about the interest cost, the cost of the money. And that's a significant expense when you buy or sell a house, because people think, oh, I bought this house for 100, I sold it for 500, I made $400,000. And well, you actually didn't, because there's 3% closing costs when you buy, 3% closing costs when you sell. There's property taxes in between. And then you also, because it's leveraged, you made more money, but you also paid interest on it. So on a 6.13% interest rate, for instance, on a 30-year loan, $100,000 loan, you paid back the $100,000 principal over 30 years, but you also paid $118,000 in interest. So your total cost on a $100,000 house would be $218,000. So if you think, oh, I bought it for 100, I sold it for 5. I made 400,000. So, well, no, you didn't make 4. You made about 2. And then out of that 250 or 260, you probably had to pay, property tax, upgrades that you're not thinking about. And when you're buying and selling, realtors commissions, the cost to the county to record these things. So it ends up being a very expensive thing to buy and sell, and that takes away from your total return. And as I said, over time, even these great things that Warren Buffett has bought and sold, like this great deal he got on the beach house and this house in a working class neighborhood in Omaha, which ended up appreciating quite a bit. You would still done much better off just investing in the stock market, because over time, the stock market returns about 10% on average a year, depending on who you ask and how you calculate it. But inflation eats up about 2.5% of that. So generally, the real return on investing in an index fund will be about 6.5 or 7% above inflation every year, year over year. And houses generally, over time, do a little bit better than inflation. And there's times when they do better than others. During the COVID lockdown, certain areas of the country, for instance, Austin and Miami and places like that, some of them appreciated 50%, 60% a year. But that's an aberration. That doesn't happen all the time. Normally, as I said, for the entire country as a whole, the real estate will appreciate slightly more than inflation. So if inflation goes up 2% a year, generally housing will go up 3% a year. And that's on average. And places like New York and San Francisco, they go up more than that or have over time. And places like Detroit, they've done much worse than that over time. But this is just on average. You should expect it to go a little bit more than inflation every year. So you won't lose money investing in a house, especially because you're buying money in today's dollars and you're paying it back in future dollars. But generally, it won't be anything to write home about. You might make a lot of money because of the leverage, but on an unlevered basis, real estate isn't that great of an investment. And it's the leverage that's giving you the return, not the asset. And if you could find a way to invest levered in the stock market, you would get this better returns. But with investing in the stock market, if you trade on margin, you're subject to margin calls, which could force you to sell at the worst time possible. And that won't happen with real estate because if your house goes down, they don't call your mortgage. And I should mention that part of the reason that the investment in the real estate in Omaha did so well, it's because he's there, and a lot of the early investors in Berkshire Hathaway are also from Omaha. And when you have a lot of rich people in an area, that tends to bring up the price of housing, and that helps out. So if we compare Omaha, Nebraska to a similarly sized city in the Midwest, Tulsa, Oklahoma, you'll see that the median home cost in Omaha is $239 versus $150,000 in Tulsa. And Buffett's house is about 4 times his price. So that house in Tulsa might be $600,000. So a lot of it is helped by the fact that Buffett and Berkshire Hathaway and the amount of people that invested in it early and made a lot of money have helped transform Omaha and made it a much better city, better developed and punching above its weight class in terms of housing prices. And I was there last year in Omaha for the annual meeting, and they're redeveloping the riverfront, so there's a lot of money being poured into it by the success of Berkshire Hathaway and people who live in Omaha, which you probably couldn't say the same for Tulsa. And if you look at this house, I mean, there's nothing exceptional about it. It looks a little different now. Now there's a giant privacy gate there, which I don't know when they installed that, but when I tried to take a picture, I was shooed away by the guards. So security is a lot tighter. But it's still a nice house, and doesn't take away from anything. He enjoys his privacy, and if you're the richest guy in the world, I'm sure there are people who want to intrude on it. Another thing that can affect mortgages, which is difficult to model and difficult to talk about, is the interest rate that you pay. So as you can see, prior to the lockdown, interest rates were the lowest they had been in memory. So a lot of people bid up the price of housing, and housing did really well as interest rates went down. And as interest rates went down from the 80s to 2020, that actually corresponded with a bull run in the stock market. The stock market went the exact opposite way. And, this area where in the 70s, when interest rates were going up, that was a period that was known as stagflation, where you had a stagnant economy and inflation, and the Jimmy Carter years. And it was very bad for America and very bad for housing prices. But if you had bought then, you would have done all right. And actually, people don't remember this, but in the 80s, interest rates got as high as almost 18%. And I remember after this, in the early 80s, my dad had gotten a mortgage on a house, and I think he paid 12 or 13%. And he said it was a great rate at the time. And I guess, if you're comparing to 18, the prices are coming down. But, now if you told somebody you were getting 12% or 13%, they would assume that you're some pride borrower, and somebody's roasting you over the coals, and you're getting ripped off. But that's because we have a short memory, and I was in school back then, but I had no idea that interest rates were this high. But it did happen in my lifetime. So anyway, from the early 80s, the interest rates came down, not in a straight line, but from almost 18% on mortgages down to 3%. And then you saw this giant rise in housing prices and in the stock market, which Warren Buffett has said with regard to stocks, that interest rates are like gravity. And if you lower the interest rate, lower the gravity, and the thing floats higher. And that's responsible for a lot of the return on the S&P 500 over that time. And these numbers are printed on Investopedia, but they're from the St. Louis Fed, which is part of the Federal Reserve Board, and so these numbers are pretty accurate. And let me do something else here before we go. And so we'll end here on this beautiful view of Laguna Beach. And some of you may have a beach house or a lake house or a hunting lodge or some other vacation home, that your family has gone to. And, you might say like, well, you're just thinking about the numbers, but, having this house that my grandfather built in the woods that, all my family goes to on vacations, something like that is priceless. And you know what, maybe you're right. And this is not the right way to look at it as dollars and cents. And, as I said, this isn't comparing apples and oranges. This is apples and a hammer. And there's things that aren't reflected in the price. And, if living on the beach and having a place that you can go on vacation where it's yours and it's not an Airbnb, you don't have to check in a hotel, that means something to you and it's worth something to you, fine. But, just from a numbers point of view, investing in real estate versus investing in the stock market on a purely unlevered basis, you're much better off investing in the stock market because of the leverage. As I said, real estate does offer some advantages because you're making levered bets, and you won't get called on the for margin call if the price goes down. You can refinance without penalty, so you've got a 30-year window there. And if interest rates move in your favor, you can refinance. And if interest rates move against you, you're locked in for 30 years, and then the bank has to take it. You come out way ahead. And, as I said, another advantage is you're borrowing in today's dollars and paying back in future dollars. So, that usually works in your favor because, every year since World War II, we've been printing more money and more money, and the odds of that reversing anytime soon are not big. So, if your house goes down even 30%, but the dollar goes down more than that, you'll still come out ahead because you're sort of making this spread bet between the US dollar and a fixed asset. So there's this joke about these two guys, and then they're in the jungle and they see a lion, And one of them says, what do we do? And he says, run. And then the other guy says, we can't outrun a lion. And he says, I don't have to outrun the lion. I just have to outrun you. And so that's a way to think about housing, because you're buying a fixed asset over a long time period, and you're going to do better on that asset normally than against the dollar. So if you look at since the 1970s, Warren Buffett bought this house in 1971. In 1971, we went off the gold standard, and at the time, gold was $35 an ounce. Last time I checked, I think it was about $2,000 an ounce. So your dollar would have lost about 95% of its purchasing power. And if you bought a house, and you might think, oh well, what if housing prices come down 30%, the next few years? Well, if you hold it for 30 years and the government keeps printing as much money as they're printing now, the odds are pretty good that your dollar is going to lose another 95%. So as long as the house goes down less than the dollar goes down, you'll still come out ahead. And that's usually a good bet to make. And there's a few assumptions there. One is that we will print more dollars now than we have in the past. Not guaranteed, but over the history of the republic, that's been the way it's gone. And the other assumption is that the further decline in the dollar will be linear. And there's no guarantee of that either. I mean, it could accelerate the decline of the dollar if we experience hyperinflation or stuff like that. But just making some very basic assumptions that the dollar will keep going down in a linear fashion, and that house prices historically, unless you're in a place like Detroit, don't go down more than the replacement cost of the asset. So you're making a pretty good bet that real estate in the long run will turn out in your favor. And you get these intangible benefits as well. You get this beautiful beach view, you get a place to spend with your family, you get a place to live with your wife and raise your kids and make memories. And those are things that can't be quantified. And if that's part of why you're buying, then, more power to you. And this isn't a knock on Warren Buffett. I'm the hugest Buffett fan. I've been to Omaha for the annual meeting. I have his letters. I've read them all, and Berkshire is my biggest individual holding. And again, this isn't a recommendation. It's not investment advice. It's just me telling you that I'm a big fan of Buffett, and I'm not shit talking him. I'm really a big fan, and I think Warren Buffett bought these two houses not because they were a screaming deal or an incredible investment, but because there's non-monetary reasons to buy a house. And he was married at the time, and happy wife, happy life, and I'm sure that played into it. But you have your own reasons for buying a house, you have your own reasons for selling a house, and you make your decisions based on that, and what allocation you want to give to real estate in your portfolio. It's generally good to diversify not only across different stocks but across different asset classes. So if you want to have part of your portfolio in real estate and part of it in stocks and part of it and anything else, you diversify the way you feel most comfortable. So anyway, I'm going to put out a few more videos on this. So just like and subscribe to this so you can see any updates I have, and I'll see you guys soon. Thank you.